Hello, traders. We are back here at TRADEPRO Academy. So I want to welcome you all to our channel, and we're going to be doing yet another video today. So in today's video, what I'm going to be talking about, it is that time of year. It is coming into the summer seasonality. So we got summer seasonality right around the corner. If not, we've seen it already starting to trickle in. And summer seasonality is generally synonymous with slower market movement. So slower market movement for day traders is a huge pain in the ass, and there is multiple different ways to go about it, and that's exactly what I'm going to be talking about today. So there's always a transition point in summer seasonality, in slower markets in general, regardless summer or not, but it's a perfect time to be talking about this. So in slower markets, there's generally a transition. We're used to higher volatility, bigger volume, larger moves, and being able to catch multiple opportunities on a day-to-day basis. But when markets slow down, you get left with 1-2 opportunities, if that are very good. And if you miss those, you end up doing something horrible. So I'm going to be talking to you guys about that today and breaking that down a little more. So we're going to jump into it right after this intro. And I want you guys to smash that like button and stick around for this video. So I'll see you guys after. Now, slow markets are generally synonymous to summer markets, where everyone talks about sell in May and go away, right? Everyone leaves their desks, volume drops off significantly, and we get very tight moving markets, little ranges, little expansions here and there, and just general trickling around in the futures markets, right? As a day trader, it's not necessarily something you want to see. You want to see high volume, decent moves, expansions, right? Not really failures to reject. And it gets tough, right? It's a tougher period, and I've had a week or two of tougher adjustment that's been a little more difficult to trade because I'm deviating away from the information that's provided in front of me. So when we look at seasonality, when we look at slower markets, faster markets, whatever the case may be, from a seasonal perspective, they get slow in the summer. Another thing that we can look at is going to be daily volume on the S&P. We can look at VIX as well to give us an understanding of the extent and the expansion of the possible markets. So when we're looking at this, we got VIX on the screen. VIX is a volatility gauge for the S&P 500, right? It's like a fear and greed volatility index gauge, call it what you will. That allows us to understand when we've peaked in volatility, when volatility is relatively low. And you can see we are in fairly historic lows in volatility. We're in a period of time where volatility is super, super low, and that's been going on since about December with a few spikes here and there. So when volatility is under 13, 14 on the VIX, realistically, you are expecting to see slower movement in the markets, so you want to lower your overall expectations. When it comes down to the S&P 500, you really, really want to lower your expectations of VIX is under 13, 14. So another thing, if we're trading the S&P 500 futures, is looking at volume. On a day-to-day basis over the last few weeks here, the beginning of May, at the end of April, we've seen historically low volume days, the lowest we've seen in years, actually. So coming into the market, one of the gauges that I look at, right, you can look at relative volatility, which is a great gauge. You could also look at the daily volume. When I look at daily volume right before the market opens at like 9:29 or whatever the case may be, 9:30 a.m. Eastern, I'm going to be looking at a daily volume that's at least 250,000 contracts that have been traded since the open of the extended hours trading session at 6 p.m. Eastern until we get the US market open. I would like to see something of the sort. So when we have 200,000, 250,000, you're getting a relatively okay volume, like for summer trading in slower markets. It's enough to find decent moves, but if you come in with 300, 400,000 contracts before the market even opens, you're realistically going to see better moves. So when we look at these slower markets and we can gauge it even before the day opens or the period of seasonality we're in, if volatility is extremely low, we can get a decent gauge of how slow these markets are, and we want to adjust ourselves to that. So people are used to seeing multiple trade opportunities on a day-to-day basis. They have one trading style or strategy that works throughout and then might not work in slower market environment, just like options trading, for example. If you're a directional options trader and you enter a period of low volatility, low movement, your options are going to get eaten up. But if you're someone that sells options, well, those are times that you thrive. So we have to understand the differences in order to shift the way that we trade, our strategy slightly, and so on. So when we look at strategies, right, from a strategy perspective, a system perspective in the S&P 500 or futures or NASDAQ, we'll talk about both. We generally, or people generally have different strategies for different things, whether it's a breakout, a fade, whatever the case may be. But a lot of people have different trading strategies based on the market environment itself. So quicker, faster markets, you tend to be more aggressive. You can put on a little more risk because there's going to be more opportunity. Now, one of the things that I like to follow is a volume-based strategy, right? A volume and order flow-based strategy, because it's an over-encompassing strategy. What that means is that it's not environment-specific, it's not volatility-specific, it's operator-specific. So we're looking at the same information throughout the year, but in slower markets, we can adjust our expectations, trade smaller, expect less of a move, and trade more selectively. We can trade more selectively with that. So I did talk a bit about that towards the end, but when we look at slower markets, generally speaking, from a day trader perspective, they cause a lot of frustration, right? They cause traders to overtrade to make up for their the lack of opportunity, right? They oversize to make up for the lack of opportunity, looking to make their general profit target in a slow market that doesn't provide such opportunity. They size up for it. They generally might look for even extended moves if they're not there. They might change the way that they trade or view the markets because of frustration of the slow moving markets. Now, in slow moving markets, you really want to limit your trade quantities and your size. In a typical market environment on the S&P 500, for example, you're most likely going to see maybe 1 to 3 great trade opportunities on a day-to-day basis. I mean, A+ setups that are very, very, well, let's not say obvious, but you don't want to miss them. When you're trading a slower market, you're generally going to see way less of that, maybe 1 to 2 on a day-to-day basis, maybe like 5 in a week, a handful in a week. And you want to adjust your expectations when this changes, when this seasonal movement changes. So I want you guys to think of trading as a business. This is where it kind of clicks for a lot of people. If you think of trading as a business, businesses, they're not like all year round for the most part, right? For the most part, they're not all year round, just like bustling, going crazy, hitting targets, just growing nonstop and expanding, right? A business generally has busy periods and they have slow periods. The busy periods, you step on it, you do what has to be done, you make your money there. It's the same with the markets. Busy, more volatile markets, larger moves, you hit it there. And then when it shifts, like businesses, you're going to have slow periods. And in a business with the slow periods, all you're trying to do is reduce the expenses, reduce the activity, and look to survive. So it's the same thing with the markets. You want to look to survive in these slower moving markets. And how that's done is you're decreasing your trade size and quantity, and you're increasing the risk management. You have a huge focus on risk management in these periods because you don't want to end up over trading, oversizing just to make up for what you were making in a volatile or faster moving market condition. So the only changes to the strategy that I like to look at is the frequency and the sizing of your trades. So consider markets that move, right? When you're in a period of lower volatility, for example, right, when VIX is glued into the lows right now and it's rotating around 13, 12, 14, you don't want to just like trade one market. As a futures trader, as a day trader, you want to be more malleable. You want to understand there are other markets, some that move. Let's compare the NASDAQ and the S&P 500. On a day-to-day basis, the S&P 500 generally has moves that are about like 20 odd points, right? In a slower market, they might be even less. So on a general average, right, some of these days are exceptions naturally because we've had a massive run on today's session. But generally speaking, when we enter a slow market period, look at the last few days here, right? A lot of these do encompass the overnight session, but you're generally looking at an average move about 20 points. You compare it to something that actually moves a lot. Even in a slow moving market, the NASDAQ's going to be presenting you with opportunities that sit 50, 60, 100 points on a day-to-day basis. So you might want to consider looking at different assets as well. You have to be malleable as a futures trader. You don't want to just be glued to one asset and then trying to extract, like milking a rock, right? You can't milk the rock. If the S&P doesn't provide you more than like 4 or 5 points on a day-to-day basis and you miss it, right? Then you're expecting that on a day like this, for example, that rallies and you miss that large move. You're trading a range and sometimes there's expansions. When you trade things like NASDAQ, you have the opportunity to look for larger moves. You have the opportunity to look for a more volatile swinging market that gives you that kind of juice. So people also get killed from boredom in these slow markets. Slow markets generally range like 70 to 80% of the time, and then you have this kind of expansive move like today, and people are glued to trading these ranges where you can sell the tops, buy the bottoms like the last few days, right? Last few days, you can see over here, this was the trading day, this dark blue area, right? It's very tight, it's very small. Into the end, we rallied a bit, but from 9:30 until about like 1:30 p.m., you got to move down to like 42, and the high is about like 60, right? That's not even 20 points. And then the expansion happens after. The day before, if you're not trading the overnight session, look at this thing. This thing peaks at like 62. There's a drop down here, about a 30-point move pretty much. The day before that, right? Same thing, about a 30-point move. So you're getting these very tight little ranges. And from this period right here over to here, it's about like 4 hours where you move about 6-7 points. You take a look at the NASDAQ, for example. Obviously, today is a little more of an outlier. It's a little exception here based on the movement that we've had because we've rallied from these lows into this like 450 all the way up to 700. But even on days that are considered slower, like if you take a look at what happened yesterday, for example, we got a nice little move. The bottom band of the move sat somewhere at like 260, the top band 100 points away. And even more after that. So even on slower moves, slower days, the NASDAQ's still providing like 60 to 100 points, while the S&P, if you catch the tops and bottoms, you're sitting at like a 20-point, 15-point move. So you got to be a little more malleable in these circumstances. So when it comes to slow markets, at the beginning of this video, I did mention that I generally trade one trading strategy. It's volume-based, it's order flow-based, and regardless of the market condition, if you stick to these general rules of how markets move based on auction, you're still going to get the opportunities, you're still going to get the trades, but in a slow market, remember, you have to adjust a few things. Increase the risk management. You want to understand how you manage risk. So I'm going to be trading smaller size. I'm going to be trading less frequently, and I'm going to be looking for smaller moves realistically. But the way I approach it, the way I view the market, the way I read the market based on auction stays the same. So if we take a look at this, right, I want to be able to even overqualify trades rather than underqualify and say, okay, that's great, it's good enough, let me take it. But the reason behind that is if it's a bad trade and no other opportunities arise, I sit there for 7 hours and nothing comes about, you're going to be left in the dust and it's going to hurt. You're going to take the loss on the day and that's it. So if I just trade my system, my strategy based on volumes, I'm still going to be looking at the volume profile and understanding as to where markets are balanced and where they're imbalanced, right? Where there's heaviness of volume, I can look at the market profile if there's expansion. But if I'm in a balanced region, right, I want to trade the ledges of that balanced region. If I've moved up into that balanced region from below, I want to lean a little more bullish, trying to buy some dips. So for example, the last few days here, last few weeks, if we look at this, we've seen multiple day ranges throughout the week with like a little expansion. So if I look at May 6th, we can say to May 10th, right? We've traded in this larger distribution. You can see here, the top is like 52.23. The bottom is 51.96. So we've expanded into it. I look at areas at the ledges of these distributions with heavy volume, and I want to be active there. I want to stay on side of the trend, right, which is currently up, and I want to be pinpointing those key extremes. If I play the extremes and the distribution edges, I have a higher probability of finding like maybe 1 to 2 trades, but they're going to be higher caliber than me trying to play in the middle. Playing in the middle with all this volume and these distribution blocks is going to get me killed. So if I can decrease the trade quantities, right, maybe I don't even have to trade every day. If the opportunity is there, I jump at it. If it's not, then we move on. But you don't have to force trades in a slower market, because if there's no movement afterwards, then you're left with the loss. Days like today, right? For example, you get a larger expansion. How do you get expansions? Number one, if you move into a new distribution that you haven't traded in a while, that acceptance generally wants to explore more. You get a news event in the morning, for example, right? That helps as well. Another rule that I like to look at is going to be based on the market profile. Now, I'm not going to dive into this too much. We'll talk about that in a different video, but if we actually expand outside of the initial balance in C or D period, I'm expecting to see some kind of a trend move. So when it comes down to slower markets, I don't necessarily think that completely shifting your trading strategy, depending on what it is going to be the solution. It's the approach that you take in the markets in terms of your risk management and your positioning, position sizing, quantities, frequency. That's what's going to make or break in a slower environment. Reduce your expectations and focus on those high probability trades, and understand that you don't have to trade every day. You don't have to trade a lot either. You're looking for those quick moves. If you can manage some wins in the morning, you walk away and don't look at this too much, right? If you're looking at a slow moving market environment that trades inside of balances, if you traded inside of balance for a week, for example, don't look for the breakouts, right? If it happens, it happens, but trade the extremes of that balance, reduce that trade size and your expectations in the market. So these slow markets, they bring frustration out of traders, right? They cause traders to get super frustrated with the opportunities there are. When the trend happens and you're used to trading a range and a balance, you're constantly against it, right? You're constantly against it, which can hurt you as well. So in the next video, I'm most likely going to be talking about finding trend moves, staying with the trend based on these profiles to lean in after this video to kind of snowball after it. So if you're trading in these summer slow market environments, refer to this video because you want to treat trading as a business. Remember what we talked about. Periods of high volatility, large movements, you want to jump into it. Periods of slow movements, slow business, you want to preserve capital, manage your risk, and take it step by step. So adhere to volatility, right? VIX, is VIX lower or high, right? Then you get some kind of an indication. Adhere to the volume that's traded on the day, right? On the S&P, under 200,000, 250,000, don't expect much. Look for the 1-2 trades, trade your extremes, and move on. So as we get into the summer season, keep that in mind, right? Don't get too aggressive because more volatility and movement is going to be coming about. And when it does, you're going to be there. So I hope you guys enjoyed this video. Hit that like button, hit that subscribe button. And for more information, check out TRADEPROacademy.com and our free Discord at community.tradeproacademy.com. So I'll see you guys there.